Hey everyone, welcome back to my YouTube channel. I'm Jason Hubbard with eXp Realty. Today we're going to be talking about the impact of inflation on the real estate market and how rising Fed rates affect mortgage rates. This topic is hitting us all right now, so I figured it'd be a good time to talk about it. Before we get started, if you could take a minute to hit the like button and subscribe to my channel, it'll help make sure that other viewers have a chance to see my content. All right, let's get into it. Let's start off with first defining inflation. Inflation is a general increase in prices and a decrease in the purchasing power of money. In other words, inflation means that your dollar won't buy as much as it used to. So, the question is, how does inflation affect the real estate market? Well, just like everything else, inflation can have a significant impact on the real estate market. For one thing, inflation can cause home prices to rise. This is because the cost of building and maintaining homes increases as inflation rises. Inflation can also make it more difficult for people to afford to buy a home. This is because the cost of a mortgage payment will increase as inflation rises. Now, how do rising Fed rates affect mortgage rates? The Federal Reserve, the Fed, is the central bank of the United States. The Fed sets interest rates, which are the rates that banks charge each other for loans. When the Fed raises interest rates, it becomes more expensive for banks to borrow money. This, in turn, makes it expensive for banks to lend money to consumers and businesses. Here are some ways to get lower mortgage interest rates in a high-rate environment. Now, of course, you're going to want to make sure you talk to an experienced lender. If you need one, just drop a note down below in the comments, and I have a few that I can recommend. There's a few options to get lower rates. There's adjustable rate mortgages, known as ARMs. ARMs have an interest rate that can fluctuate over the life of the loan. This means that your monthly mortgage payment could go up or it could go down over time. ARMs can be a good option for borrowers who are willing to take on some risk in order to get a lower interest rate. However, it's important to understand how ARMs work and the risks involved before choosing an ARM. Outside of ARMs, there's also interest rate buydowns. These have gained popularity again here in the last couple of years as rates have risen rapidly. New construction builders have been offering these a lot lately. A buydown is a temporary reduction in the interest rate of a mortgage. This can be done by the seller, the lender, or the third party. Buydowns can be a good option for borrowers who need to lower their monthly mortgage, in the short term anyway. And you can use closing costs, concessions, stuff like that to help buy that down. However, it's important to note that buydowns will not lower the overall cost of the loan over the life or over the term of the loan. In addition to ARMs and buydowns, there are a number of other things that you can do to get a lower mortgage interest rate in a high rate environment. You can shop around and compare offers from multiple lenders. Don't just take the first mortgage rate that you get thrown out there. Mortgage rates can vary significantly from lender to lender, so it's important to shop around and compare offers before you choose one. Get pre-approved for a mortgage before you start shopping for a home. This will give you the best idea of how much you can afford to spend and how much you can afford for your monthly payment. It will also show sellers that you are a serious buyer and that you're likely to qualify for a mortgage. Another thing you can do is to make a larger down payment. The larger your down payment, the lower your interest rate will be. This is because lenders view large down payments as a sign that you are less likely to default on your loan. And really, that's what they care about. It's all about risk. The less risky you are as a consumer, the more likely you are to get a better rate. Choose a shorter Loan term. Shorter loan terms have lower interest rates than longer loan terms. This is because lenders view shorter loan terms, again, as less risky. Improve your credit score. A higher credit score will qualify you for a lower interest rate. You can improve your credit score by paying your bills on time, keeping your credit utilization low, and avoiding new debt. Again, better credit scores, less risk, lower rate. Here are some additional things to keep in mind when considering ARMs and buy downs. ARMs can be a good option for borrowers who are comfortable with the risk of fluctuating interest rates. However, it's important to understand how ARMs work and to choose an ARM with terms that you are comfortable with. Buy downs can also be that good option for borrowers who need to lower their monthly mortgage payment in the short term. However, it's important to note that buy downs will not lower the overall cost of the loan. We mentioned that earlier. You're going to want to talk to a good lender about these buy downs and these ARMs. Additionally, buy downs may come with some additional fees that your normal loan isn't going to come with. It's important to weigh the pros and the cons of each option before making a decision. And again, it's also important to talk to a qualified mortgage lender to discuss your individual needs and to get advice on the best option for you. Those professionals specialize in loans. Those are going to be the best individuals to talk to you. I have a few great lenders if you need a referral. If you're finding this information valuable, please remember to quickly hit that like button and subscribe to my channel. That way you can get information as it comes out. And if you want more information on mortgages, check out this video here. Okay, now let's get back to inflation. What are the current inflation numbers? Well, according to the U.S. Bureau of Labor Statistics, the Consumer Price Index for all urban consumers rose 8.2% over the year, ending in September of 2023. This is the highest rate of inflation since 1981. Now, many of you aren't even that old to understand what that means. What can you do to protect yourself from the impact of inflation and rising Fed rates on the real estate market? Well, there's lots of things, lots of little things you can do. Create a budget and track your spending. This will help you see where your money is going and identify areas where you can cut back a little. Pay down your debt. Obviously, as things get more expensive, it's not always easier to pay down your debt, but if you can pay it down, the less debt you have, the less you will be affected by rising interest rates. Invest your money wisely. Investing your money in assets that tend to perform well during inflation, such as stocks and real estate, can help protect you and your purchasing power. Increase your income. Not always as easily done as it is said. If possible, try to find ways to increase your income, such as getting a raise at work or starting a side hustle. Shop around for the best deals. Compare prices at different stores and online retails before you make that purchase. Buy in bulk. If you have the space, buying in bulk can sometimes save you money on items that you use regularly. Use coupons and promo codes. There are ways to find coupons and promo codes online and in print. These can help, and everything helps in a little way. Cook at home more often. Eating out can be expensive. Cooking at home is a more affordable way to eat, and it can also be healthier. Reduce your energy consumption. By making small changes such as turning off lights when you leave a room, unplugging electronics when you're not using them, you can save a little bit of money here and there on your energy bills. It's important to note that there is no one-size-fits-all solution to protecting yourself from the impacts of inflation and rising Fed rates. The best approach for you will depend on your individual circumstances. However, by following some of these tips above, you might be able to take steps to reduce the impact of inflation on your finances. For more information on inflation, I've included some links down in the description. If you're thinking about buying a home, it's important to understand how inflation and rising Fed rates can affect the market. Here are a few tips to help out with that. Get pre-approved for a mortgage before you start shopping for a home. This will give you an idea of how much you can afford to spend and how much your monthly mortgage payment will be. Be prepared to act quickly. In a competitive market, homes can sell quickly. So if you find a home that you like, be prepared to make an offer right away. You can consider buying a fixer-upper. Fixer-uppers can be a great way to get into the real estate market at a lower price. Just be sure to factor in the cost of repairs and renovations when budgeting for your purchase. You can also look, maybe you have to downsize a little bit from what your ideal home is, but it's another way where you could potentially save some money and get into the real estate market. If you're thinking about buying or selling a home, it's important to talk to a qualified real estate agent. We can help you understand the impact of inflation and rising Fed rates on the market and help you make the best decision for your needs about when to buy. Thanks again for watching. If you have any questions about the impact of inflation and rising Fed rates on the real estate market, please leave a comment down below, or you can reach out to me at 480-588-2281. Or even click on a link that takes you down to my website down below, and we can also conversate there.